Hello and welcome to Market Domination. It's Wednesday, May 28th. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And we are getting you up to speed. There's just 1 hour before the closing bell rings on Wall Street. Plus, be sure to stay with us today for our special coverage of Nvidia's earnings report that starts right here at 4:15 Eastern. And now here is your headline blitz.
Technically, we're in for a period of a little bit of consolidation. We have some, pretty big potential catalysts, as we move through the summer, to work through in terms of, kind of the tax bill, the 90-day reprieve rolling off, right? So we'll have to kind of see how some of that plays out.
Macy certainly is a troubled company, and that's reflected in the valuation right now. Macy's is in the process of closing a large number of stores, closed a lot last year, closing more this year, will close more next year, to focus on the stores that are performing better. Now, we're not really seeing positive comps from those stores, so it's certainly, at this point, uncertain that Macy's can really turn it around.
I mean, I think by and large, everyday investors who are leaning crypto are getting more and more into it. I know those of us in the chattering class see a lot of ethical problems with the things Trump is doing, and that's correct. But I think for the average person, it's like, the president is buying Bitcoin, I'm gonna buy some Bitcoin, Like, I think that's the way it's going.
We got 1 hour to go into the market close, so let's take a look at the major averages. A bit of a meh kind of day, as we like to call it around here. The Dow right now down about 150 points, about 0.4%. The S&P 500 down 1/5 of 1%. And the NASDAQ, very little change. That's because we're waiting for after the bell, baby.
That is correct.
Like people aren't really focused today.
Meh, muted. I think those are all fair descriptions. We had different puts and takes today. We had the FOMC minutes.
Yes.
Not a lot new there, to be honest. And of course, that came before the U.S.-China trade truce. You did have participants again talking about, yes, you guessed it, uncertainty. That word was out there about trade, about fiscal policy. But listen, we know what's on deck today. It's Nvidia earnings day. Big, well-known, well-owned name. By the way, heading into this print, what a move for Nvidia. You're up about 40% from that April low. But, questions, Julie, not just for Nvidia, not just for Jensen Huang Company, but bigger questions. What is it going to mean for the market potentially, direction of the market, and for that mega AI trade and trend we talk so much about?
Yeah, to your point, the stock is up 44% the last time I checked it from those lows. That was April 4th when we saw that low, but they're not much change for the year, especially by Nvidia standards. And if you look over the past year, yes, it's up 20% sort of date to date, but we haven't really gone that much of anywhere, especially again, if you're looking at the recent standards of what Nvidia has done, right? So you had, of course, this big surge, and then it's kind of remained in this range since then. And there are a lot of questions about the report today and kind of its implications, not just for Nvidia, but for the broader market.
Yeah, for Nvidia, it's interesting. You hear analysts talk about how it could be kind of a noisy quarter.
Yeah.
Not just because of the macro uncertainty, but because of Nvidia-specific issues, the H20 ban to China. It'll be really interesting, Julie, just how CEO Jensen Huang talks about that, how he sort of frames that for the street investors, not just what it means for this quarter, but how he thinks about what it means for guidance in the forecast.
All right, well, without further ado, let's talk more about Nvidia, right?
Yes.
Because we are about an hour away from Nvidia's first quarter earnings. Here for more on what to expect, Yahoo Finance tech editor Dan Halley, who already, I feel like, has put in a 12-hour day, and it's miles to go before we sleep, Dan. So what are you watching specifically?
Yeah, I think for me, the big story is going to be around the China revenue that Nvidia is expected to generate. Obviously, there's been a lot of discussion about those H20 chip bans that the Trump administration had put into place. They had been developing, or they developed the H20 chip to get around prior bans to their previously more powerful chips. And so the fact that this is now banned is a big deal. And I just want to look at some of the revenue that was expected to come out of China this year. We were supposed to be seeing 150% year-over-year boost in overall revenue from China to $6.2 billion. That would have been up from $2.4 billion that it sold in that region last year. Now, NVIDIA is obviously going to take that $5.5 billion hit on the inventory that they have, the orders that they have for those H20s. So what happens next when it comes to China sales? Reuters had reported that Nvidia is working on a less powerful version of the H20. Huawei has its own competing chips. The idea, Jensen Huang has said, is you want to have American technology part of this broader conversation in AI, not just let other companies from other countries take over and then not have any say in the matter. So that's where I'm going to be primarily focused. And obviously everybody else is going to be looking at, me too, the data center revenue. That's expected to come at $39.2 billion. That would be up from $22.5 billion, 74% year over year increase. What's 74% compared to 400, though, is probably what a lot of traders are going to be thinking, that, you know, the expectations are so out of whack now with the prior jumps. And then obviously gaming revenue, not that big of a deal for Nvidia. I mean, it's $2.8 billion is what's expected. I'll take that. But when it comes to the data center revenue, it's not really the kind of go-to that is. And I think one of the other things to look at is the overall revenue is going to expect to come in at $43.3 billion. That would be a jump from $26 billion last year. So I mean, they're looking at a healthy quarter. I think, you know, we've spoken about this. The past quarters with Nvidia is, are we going to sell, are investors going to sell on the announcement because they're just not as excited as they previously were? Or are investors now starting to get used to, this is kind of the cadence you could expect as far as growth goes? We'll have to see. I think one of the other things real quick to keep an eye on is, where's that revenue coming from? You know, Nvidia says 50% or around there comes from the hyperscalers, the Microsofts, the Googles, the Amazons, Meta, obviously one of them. What's that ratio now, right? I mean, now
are they diversifying more?
Right, and that's kind of where you get into that conversation with Saudi Arabia and the United Arab Emirates, that idea that Jensen had been pushing of sovereign AI, that fits right in there. So is that starting to take off more, or the hyperscalers continuing to dominate? And I think one of the things that's important to keep in mind is, as part of that whole Middle Eastern visit that President Trump had, were kind of discussions of deals for American companies to build there. So that would also naturally mean more Nvidia sales.
All right, thank you, Dan. We'll be hearing much more from you all through the show. For more on the latest market moves and how those highly anticipated Nvidia earnings will impact investors, let's welcome in here Scott Kroner, City Head of U.S. Equity Strategy. Scott, always good to see you. So let's start there, Scott, with Nvidia earnings after the bell. I'm curious how you're thinking through that, Scott, as a strategist, as you try to think through potential implications of this Nvidia report for the market, Scott, for the direction of the market, for that mega AI trade and trend.
Well, Josh, great being on. Okay, so let's start at the beginning. So Nvidia currently is about a 6.5% weight within the S&P 500, number 2 just behind Microsoft. So the weighting effect alone makes this a pretty big deal, right? Now, in terms of our view towards Nvidia, the broader semi space, we've been overweight all year. We reaffirmed that overweight going into Q2, when overweight tech is part of that. What I would focus on here, a little bit different, right? So this is actually the 2-year anniversary that we're running into now, relative to back at this point in 2023, when we first began to get that big upside beat and raise in expectations that began to get the stock really going. I want to focus on that because what really is important and telling is the degree to which we see this year, full year 25 calendar, as well as out year numbers begin to move higher, okay? What had been happening over much of the past 2 years was this major step function up higher in terms of out year earnings growth projections that aligned really closely with the stock price action. The rate of improvement in out year expectations, though, began to decelerate as we went into the back half of 24. Back in the fall, we began saying, hey, Nvidia is set up to become just another stock. At a $3 trillion market cap, it's hard to see yet another double. But the point here is that what we're laser focused on is the trajectory of future growth expectations, and do they begin to shift a little bit higher from here?
So I guess, what's your answer to that question, Scott? Do you think that they will start to shift higher? Or do you think that the sort of moderation in those expectations is going to settle in?
Yeah, so where I think this is going, Julie, is that we've been navigating a storm around tariff and China concerns. And for the most part, that's gotten priced in. The company's been pretty vocal and visible in terms of a market environment for their products. Now, we can talk about how that might influence gross margin trajectories. We'll be keeping an eye on that. But I think at a minimum, Julie, what I need to continue to see is that the projection of forward growth, and right now Nvidia is projected to grow earnings 40% or so this year, continues to persist, right? So I need to see that higher slope in terms of the earnings progression. I think we're going to get a taste of that. Now, whether it meets implied expectations, given the strong move we've had since April 9, is probably the trading noise around here, but pretty comfortable that you're still looking at a decent next couple of year trajectory for their fundamental growth profile.
Scott, another big theme for investors, I know you're watching it closely, Trump's budget bill, Scott. Walk us through how, again, as a strategist, you're thinking through potential ramifications for the market there.
Yeah, so this is a big be careful what you wish for. I think we all want to see spending come down. We want to see the deficit numbers come down, right? And so what we're looking at in terms of the House passed bill is a little bit of little things, but a lot of nothing. And what I mean by that is that we're looking at a $2 trillion deficit this year, and our projections are based on what we've seen in the House bill, offset by the opportunity for some tariff income. You're still looking at another $2 trillion-like deficit level for 2026. What does that mean to me as a strategist? Well, it means that the fiscal impulse that's been positive and supporting economic activity and U.S. corporate fundamentals continues to persist, okay? So deficit spending looks bad, feels bad, but it's actually a net positive for fundamentals. On the flip side, what you get as an offset to that is having to finance this, the debt that comes with the deficit. And here too, we're now expecting a perceivably higher for longer 10-year and out the curve rate environment. What that does is constrain valuations and put some concern about the ability to continue to grow. So we've got offsetting components here. On the one hand, we'll take the fiscal stimulus. On the other hand, there's a price to pay in terms of what we think is a bit of a valuation headwind for U.S. equities.
And so, but it sounds like that you think that headwind is overcomable, or it's worth it because of the stimulus, limited though it may be coming through the bill.
Julie, so let's go back to the beginning, right? So this is where we've been all in on growth as defensive as our main sort of tactical call within the U.S. equity markets for the better part of Q2. And what I mean by that is that we're going to be dealing with the deficit, fiscal components, aggregate economic activity for a big chunk of the market. But at the same time, what you have is this structural growth component that's being triggered by AI and the usage of tech in more and more companies to increase their productivity. What that does is it gives you a secular tailwind here, which kind of comes back to that Nvidia discussion, that provides an offset to a lot of the traditional economic sensitivity of U.S. equities. So the combination of those two keeps us in this mode where we want growth, we want structural growth as a means of offsetting a lot of the economic and rate noise. And as long as that persists, we think that's where the money continues to flow. And the good news within the S&P 500 is that over the past couple of decades, the weighting of that growth component has continued to shift larger. Right now, it's somewhere around 40% of the index. And so as long as that's in place, the AI spend and the impact that potentially has on productivity all becomes, at the end of the day, a tailwind and a support for U.S. equities.
And final question, Scott. We did get those FOMC minutes today. Not a whole lot new there, but I am curious to get your expectations for the Fed this year, Scott.
Yeah, so I guess our nagging concern, and we've been writing about this since the tail end of the Q1 reporting period, is that there's a noticeable deceleration in consumer sentiment. Now, we got a little bit of a positive surprise on that yesterday, but generally speaking, our concern here is that consumer sentiment continues to fade. The Fed is in an interesting position. House view is that they cut rates several times this year as we go into the back half. The Fed's in a bind here where the hard data is still telling you things are okay. Soft data tells us that there's a little bit of a consumer concern creeping in. I think all told, at the end of the day, we're pretty comfortable that a 10-year around where we are currently is okay for equities. and we're okay with market presumptions that you see the Fed ultimately cut rates in the 2 to 3 time characterization, if you will, for the balance of this year.
Scott, great to see you as always, and I'll remember that growth is defensive mantra as we await those Nvidia numbers, and we'll see how they turn out. Thank you. We're just getting started here on Market Domination. Coming up, the latest minutes from the U.S. Federal Reserve's last policy meeting. They're out. We'll discuss those on the other side. Plus, at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. And at 4:15, it is our special coverage of Nvidia's fiscal first quarter earnings report. We'll get you instant reaction to the results and take you inside the earnings call. Stick around. You don't want to miss all of that.
The latest minutes from the U.S. Federal Reserve's last policy meeting are out. Let's get to Yahoo Finance's Jennifer Schonberger for more. Jen.
Hey, Josh. Almost all members of the Federal Reserve saw a risk that higher inflation from tariffs could prove longer lasting, as we really saw that internal debate on this subject matter between Fed officials borne out in these Fed minutes from their last policy meeting. Of course, these Fed minutes released with a 3-week lag. Now, some thought tariffs on intermediate goods, so basically parts used to make products like steel or aluminum, could contribute to a more persistent increase in inflation. A few thought supply chain disruptions caused by tariffs could lead to longer-lasting inflation, akin to kind of what we saw during the pandemic, but several said that a number of factors could offset the uptick and persistence in inflation, including reductions in tariff increases through trade negotiations, consumers' low appetite for price increases, the potential for a weakening economy, or if firms move to increase market share rather than raise prices. Now, many said surveys or their business contacts indicated that companies were planning to either partially or fully pass on increases in costs from tariffs to consumers. Several noted that companies not directly subject to tariffs might also take the opportunity to increase their prices if other companies were raising prices. Meanwhile, Fed officials thought that the outlook for the job market could weaken in the coming months. They see considerable uncertainty about the outlook for the job market, hinging on those trade negotiations and government policies as a whole. And for that reason, Fed officials opted to say that we would prefer to wait for greater clarity on the impact of the administration's policies before charting a course forward on interest rates. Back to you.
Jen, thanks very much. Well, we've been hearing a lot from Federal Reserve officials this week, with a lot more commentary coming us tomorrow. And that's in addition, of course, to the minutes that Jennifer just told us about. Joining us for more, Randall Krosner, professor of economics at the University of Chicago and former Federal Reserve governor. Randy, it's great to see you. You know, we just heard about the minutes as well. We've been hearing what Federal Reserve officials have been saying. And it seems like the bottom line is, let's just wait to see what the data is going to show. What data should we be looking at, and when can we expect that it might show something?
Sure. So I think they're totally in a wait-and-see mode. That's Jay must have said that. Jay Powell, the Fed chair, must have said that 20 times in the press conference, and I think it's been repeated probably 40 times by all of his colleagues who have spoken since the meeting. So a lot of uncertainty about policy, a lot of uncertainty about where the economy is going. They feel that the job market is in a reasonable place, although it might be weakening a bit. They feel that there might be some inflation pressures coming on the tariff side, exactly along the lines of that discussion. Some people think, yeah, it's not going to be very much. Other people think, well, this could lead to a trade war and be more persistent. And so they're in this hold mode. The things that they're going to be looking for are what's happening with inflation, what's happening with inflation expectations, and what's happening with the labor market.
With inflation, Randy, we are waiting for that PCE report. You know, you look at the recent inflation reports, though, Randy, they've been relatively benign. So I'm just curious how you try to think about the trajectory of inflation from here.
And that's exactly why they're in this wait and see mode, because they had projected that inflation would gradually, although very, very gradually, come down over the next year or so and finally get to their 2% target sometime by the end of next year or by 2027. With tariffs and the potential for price increases that could be involved in that could disrupt that process. The key to it, though, is it a temporary disruption? So yeah, you impose the tariffs, prices go up for a little, they adjust, but the inflation process doesn't change. The inflation rate can continue to move down, or does it lead to more and more price increases, and in particular, people becoming worried that, gosh, they told us last time that the prices weren't go up, and they did, and so maybe we can't trust them this time. So that's why they're very much looking at the inflation expectations.
Randy, it's interesting. I've been starting to hear certainly anecdotal reports about price increases, some of them explicitly tied to tariffs by the retailers or manufacturing companies that are making these price increases. When people start to see evidence, even if it's not widespread, does that then tend to feed into those inflation expectations?
Well, we really don't know exactly what drives the inflation expectations. One thing we do know that it's affected a lot by gasoline prices, and those have been relatively low compared with where they had been before. But if you look at survey measures of inflation expectations, and they mention this in the minutes, those are up quite substantially. So people are clearly worried about that. And the concern is that this becomes self-fulfilling. If people are worried about it, then they'll be more willing to tolerate those price increases. They'll be more demanding in asking for higher wage increases, increase in costs, and it just kind of fulfills itself. I don't see any evidence of that yet, but that's a legitimate concern.
How, Randy, would you characterize the American consumer right now? How healthy, how resilient? We did hear from a number of retailers today, Randy. They reported results. I think broadly investors seem to like what they heard, but I'm curious to get your take.
Yeah, so we saw consumer sentiment plunge over the last few months with all the concerns about tariffs and trade wars. And then the most recent number that just came out from the conference board, a spike back up. Not all the way to where it was, but a big spike back up. We'll get some more information, I think, on Friday from the Michigan Consumer Confidence Survey. As people sometimes joke, a recession is everywhere except in the hard data. So people say they're in recession, people say that they're very concerned and they're not doing anything. But if you look at the data, whether it's the specific company-specific things or more broadly, retail sales seem to be there. So I think people got a bit rattled, but my guess is they're going to kind of power through it.
And so it seems like we could be looking at a slowing economic trajectory, but not one that is grinding to a halt or even contracting when all is said and done.
Yeah, I mean, who knows what shocks may come, and who knows how policy will develop, and that's exactly why the Fed is talking about uncertainty and in this wait-and-see mode. But it seems like things have calmed down a bit, both on the policy side and on the way the markets are interpreting it. So that suggests just sort of a gradual slowing, and then even though measured inflation may go up slightly for a few months, it probably will be on a trajectory back down to their 2% goal. But that's going to take time.
Randy Krasner, thank you so much. It's always great to chat with you. Got some breaking news here, and this is based on a report from the Financial Times that President Trump is ordering U.S. chip software designers to stop sales to China. Again, that's according to the Financial Times. The U.S. Commerce Department telling electronic design automation companies, they include the likes of Cadence and Synopsys and Siemens EDA, to stop supplying their technology to China. That's according to that report. These companies are pretty vital in the semiconductor making process because they do help with the sort of architecture of designing these chips. So Synopsys, for example, we've spoken to the CEO on the show many times, Sassine Ghazi. Nvidia is one of its biggest clients. It works with many of the big chip makers, as does its main competitor, Cadence. And so we've reached out to that company for comment. I should mention, by the way, Synopsys is also out with its earnings after the close of trading today, much like Nvidia, its big client. The shares, by the way, up a little more than 3% so far this year, Josh.
Yeah, I mean, this would be a pretty meaningful effort here by the administration, the Trump administration, to try to, in some ways, slow down China's abilities here, tech advances, tech aspirations. Commerce Department official telling the FT was reviewing exports of strategic significance to China. In some cases, this official saying Commerce has suspended existing export licenses or imposed additional license requirements while their review is pending.
And I should mention as well, just according to Bloomberg data, Synopsys gets about 16% of its sales from China. Cadence gets about 12% of its sales from that nation. So this would be meaningful potentially for these two companies, and the stock reaction reflecting that. Well, a lot of retail names reporting earnings today. Here to round up the latest, Yahoo Finance senior reporter Brooke DePalma. Busy day for you.
Certainly was a busy day. Good afternoon to you both. It was a big day for Abercrombie & Fitch, Dick's Sporting Goods, as well as Macy's, all reporting their first quarter results that really surprised the street here. Let's kick things off with Abercrombie & Fitch. Now, the specialty retailer beat across all key metrics: earnings, revenue, and same-store sales growth, which was up 4%. And that was boosted by, get this, remember Hollister? Well, the Hollister brand actually saw same-store sales growth of 23% in the quarter. That's compared to the key Abercrombie brand's 4% decline. Now, for the full year, the company is now expecting net sales to increase in the range of 3% to 6%. That was up from the 5% at the high end of the range that was previously announced. Wall Street really liked that, but it did lower its operating margin outlook to a range of 12.5% to 13.5%, citing the impact of tariffs and mitigation efforts. Now, the company did say that it plans to relocate the sources of supply. It also plans to diversify its sourcing to 16 different countries, and also expects sourcing volume from China to be in the low single digits, and is now working to negotiate all that with vendors. But Wall Street really liking this. Stock now up roughly 13% as we make way towards the close.
What about Macy's and Dick's Sporting Goods? Two other names reported. What do they have to say?
Yeah, well, both of them beat expectations. That really shocked the street, especially in this large tariff uncertainty environment. But if we take a closer look at Dick's Sporting Goods, they did see same-store sales growth of roughly 4.5%. And that was strength across footwear, apparel, and team sports. They cited those as what really drove these results. But this didn't really come as a shock to Wall Street. You see shares up just roughly nearly 2%. They had announced the preliminary results when they announced that $2.4 billion acquisition of Foot Locker 2 weeks ago. And largely what they're hoping with that acquisition is they bring in new customers, they expand globally, as well as they emphasize that key point here, they're in the very early stages of this. They did, however, say that they expect the acquisition to be accretive to earnings per share in the first full year that the acquisition does close. And if you take a look at Macy's, similar story there. Wall Street not super excited either way. Shares roughly flat as we make our way to the close. What we saw there was same-store sales decline. Similar story here, down 1.2%. But hey, that was better than what Wall Street had anticipated there. We know we've been talking a lot about that turnaround attempt there. The stores where they invested in 125 stores, they saw a decline of down 0.8%. So yet to be seen, but the CEO told us this morning that he expects progress to be made and momentum to continue as this sort of we get past what's happening right now.
Yeah, I mean, the other question is about guidance, because across the retail spectrum, there's been a range of responses and reactions to tariffs and to whether to even have guidance at all. So what was this latest crop? What did we learn?
So Dick's Sporting Goods, they reaffirmed their guidance here. They said that includes the impact of tariffs. So Wall Street certainly pleased by that. When it comes to Macy's, though, they did reiterate their sales outlook. However, they did cut their earnings outlook due to what they said was uncertainty around tariffs, consumer sentiment, and a competitive landscape. On the call, they vouched how, yes, they import, roughly 20% of their goods from China when it comes to the Macy's brands, but they also said, hey, we work with a lot of key brands, for example, not specifically, but say Ralph Lauren and Coach, and they take on the cost to import these goods. So some leeway there, but it really remains to be seen how they will adjust prices, maybe adjust their assortment in this environment as they make way through the year.
All right. Thank you, Brooke. Appreciate it. So how should you be playing the latest earnings results from Macy's? We're taking a deeper dive into the stock in the latest edition of our series, Goodbye or Goodbye. Stick around. Much more market domination. That's still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today, we're scanning consumer-facing stocks. I'm here with Chad Morganlander, Washington Crossing Advisors Senior Portfolio Manager, and a repeat guest here on Goodbye or Goodbye. It's good to see you.
Good to see you as well.
All right, let's get to your buy stock first of all. This is O'Reilly Automotive. As I mentioned to you in the break, we've been singing the jingle all day since we talked about O'Reilly. The share's up pretty handily over the past year, so let's talk about why you like it. First of all, the size and scale and the different types of customers that they service. So explain to me what you mean.
So they have the do-it-yourselfer customer as well as they actually have the commercial customer. Their biggest leverage here is that they have the logistics to get the product to their end customer in a really quick amount of time. If you're a mechanic, you need to get that product that day, and that's what they do best.
Oh, interesting. Okay, and let's also talk about the differentiation strategy here in terms of, you know, it speaks partly to what you were talking about, the different customers, but also what they're offering them.
The customer service is extraordinary. You walk into one of these places, and before the door even shuts, they're asking if they could help you. The manager approaches you. It's really a big differentiator when you talk about retail. Also along the lines of their pricing, they are competitive. And also on the back end, they do diagnostics so that you go in there, they try to help you and figure out what's wrong, and then they try to sell you the product at that point in time.
I have to ask a quick follow on the pricing front, because obviously some of its products are going to be affected by tariffs. So do they seem to have pricing power? How is that sort of playing out?
So it seems as if about 30% of their revenues come from Southeast Asia. They'll be able to pass along some of that to their customer. Others, they'll have to go back to the manufacturer and actually renegotiate. So I expect that if there's any company that will be able to handle it, it's with the size and scale that O'Reilly has, that they will be the one that will benefit from this type of unsturdy environment within the product line.
And let's talk more then about the base upon which they're building and navigating that environment. And that's the sort of steady growth that they've been seeing.
Right. They're not across the United States as of yet. Their acquisition strategy is to tuck in other small retailers and auto part companies. They're starting to slowly but diligently expand within Canada and Mexico. This is one of the best run retailers, I believe, in the country.
Gotcha. And then beyond the country, I guess, as they go. But let's talk about some of the things that maybe could slow it down a little bit. Even though they are expanding, they're not expanding as much as their competitors have geographically.
So they do have that issue, but they also, for their top line growth, you could see that incremental revenue growth could be quite robust, due in part because they don't have yet that national footprint. Overall, we believe that they will grow around 7 or 8% on the top line through either buying or opening up stores. They have around 150 stores that they're opening up each and every year. And the store base is roughly about 6,000 stores nationally.
Gotcha. That's a lot of stores.
Yep.
You talked about how they have the do-it-yourselfer and the commercial business. Is the commercial business a lower margin business?
This could be a competitive side, and this is something you have to keep a careful eye on. So there's the AutoZones of the world, and a lot of other competitors like Genuine Auto Parts. So that could be a more competitive environment with bigger contracts that they have to get and bid on. So that's one maybe perhaps a concern that you may have overall. But over the long run, we think that the long-term growth trajectory is quite robust, and they've got the wind at their back.
All right, let's get to the stock that you do not like.
Yeah.
And that is one we were just talking about. It's Macy's, which, as we know, has tumbled over the past year. I think the drawdown is about 50% or so. We were just talking about its latest results with our Brooke De Palma. And here, the competitive landscape, I mean, can you even say the competitive landscape with other department stores? No, it's really just online, specialty, the whole competitive landscape has sort of turned away from department stores, right?
I heard a great line this morning, it's no fun if you don't get to keep it. And the reality is that you could take a picture, get a price real time on Amazon or Walmart, and then just have same door delivery. So it's a race to the bottom when it comes to how and what their product offering is, and profit margins will be pressured at all points in time. This is a levered company, but we'll go into that in greater detail. The leverage ratios are extraordinarily high. So for
what is that? They have a lot of debt is basically what that means, right?
Absolutely. They have a tremendous amount of debt. Yes, and they have properties and assets they can sell. But this reminds me a lot of JCPenney or Caldors or the other department stores of yesteryear.
Right. For people who are watching who say, Caldor, what? Exactly. Unfortunately, that was one of those department stores that did not make it.
100%. And that's really the problem here, because you're competing against Walmart and Amazon, and you can get that in less than 6 hours, the product. So they really have an issue, because this debt will perhaps have to be restructured.
And there have been some activists that have pushed them to sell off some of that real estate in order to raise cash and pay off some of the debt, but as of yet, they haven't, their flagship here in Manhattan, for example, they have not sold.
Right, and the problem is they have about $1.8 billion of debt, and those properties, the valuations are going ever so slowly, they're melting away, meaning the valuations of these big boxes are melting away.
All right, and the last reason here, I mean, this is pretty much, sales are going down.
They're trying to rationalize their store line, their footprint, and it's contracting, which then accelerates the issue at hand. So, we are very concerned about the equity holders of this company. Maybe there's an opportunity by owning the senior debt if you're one of those hedge fund, leveraged kind of guys that want to do that. But we suspect that one should stay away from this type of company.
Okay, what could go right for Macy's? This is a pretty rare one in our history of goodbye. Nothing? You don't think that this is a stock that can turn around?
Julie, I don't see a clear path out of the woods. And the reasoning behind that is everything that I mentioned. Yeah. I think that if one wants to be an investor here, they may want to look at the credit, meaning the debt, and they want to be careful even on that to go with the most senior debt instrument in order to take an opportunity in the stock.
So obviously you do not hold shares of Macy's.
No, I do not.
You do hold a position in O'Reilly?
Yes, we do.
Okay. Good guess on my part, I guess. Chad, good to see you. Thanks
for
coming in. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern, and we'll be right back. Now time for some of today's trending tickers. We're checking in on shares of Tempest AI, Box, and Victoria's Secret. Tempest AI taking a big hit today after Spruce Point issued a short sell report on the health technology company. The report raising serious concerns about Tempest AI's product, the credibility of its management, and its financial reporting practices. In a statement to Yahoo Finance, Tempest said, quote, "We do not intend to respond to a report that is riddled with hypotheticals and inaccuracies and fails to address Tempest's history of strong financial performance and impressive growth." The shares, though, are taking a hit on some of the allegations here made in Spruce Point's report.
Yeah, I mean, Spruce Point goes after the executives, they go after the company, they say it's run by leaders who have a dubious history, talks about what they call aggressive and suspicious accounting practices. We believe that owning shares, they say, is a poor risk reward on a flawed equity growth story owing to its appeal to the AI hype, despite, they say, only 2% of revenue stemming from AI applications. They're short this name. Street is fairly divided. You got 7 buys and 6 holds.
Yeah, and among other things, they talk about notable partnerships and the deal announcement with AstraZeneca and Pathos AI, that those partnerships merit scrutiny, according to Spruce Point, as they, quote, appear to be weakening and ultimately signal pressures to the company. Yep. We shall see.
Shares of cloud storage company, that would be Box, jumping after beating expectations in its first quarter, raising its revenue forecast. So in the green today, did raise that full year forecast. The street is broadly positive on this name. Citi, for example, likes it. Same Box reported, they say a strong quarter, outsized billings, encouraged, they say, by back-to-back solid bookings quarters, driven by AI features resonating. CEO Aaron Levy enjoying a nice run. I mean, this stock's up nearly 50% over the past 12 months here.
Yeah, exactly. Citi talking about the back-to-back solid bookings that the quarter has had, as you mentioned. And a lot of the analysts, in fact, mentioning the billings that the company has been seeing. So it seems as though that sort of indicator is something that folks are liking here. And anytime you throw AI on something, they seem to be liking it.
Yeah, Aaron Levy also, good talker.
Sure.
Good talker.
That doesn't hurt.
No.
Shares of Victoria's Secret sinking today as the company deals with issues on their website, with some customers saying they've been unable to shop online since at least Monday. The site showing a black screen with the text, quote, "We have identified an issue affecting the operation of our site." You see it there. That's what you get if you go to Victoria's Secret. They said in a statement to Bloomberg that there was some kind of attack or some kind of security issue, but they did not specify what it was. But obviously, in this world in which so much stuff is sold online, if you can't buy stuff from a company online, it's not great.
Yeah, and all this coming as an activist we know is circling, BBRC, trying for a takeover. They are reporting earnings next week, so I would expect we get more color and commentary then. By the way, this stock down about 50% this year. It has been shelled.
Yeah, it has been trying to turn around, to right-size its footprint, to change its offerings.
Look at that chart.
Yes, the chart tells that the story's not been working exactly.
All right, Elon Musk has announced his opposition to a second major plank of Donald Trump's agenda, saying he was disappointed by the price tag of Trump's big, beautiful bill. The president responding to the bill's criticism earlier today.
Number one, we have to get a lot of votes. We can't be cutting. We need to get a lot of support, and we have a lot of support. We had to get it through the House. The House was. We have no Democrats. If it's up to the Democrats, they'll take the 65% increase. If that doesn't get approved, this country is going to have a 65% increase in taxes and lots of other problems, big problems, almost bigger than that. But we'll have a 65% increase as opposed to the largest tax cut in the history of our country. We will be negotiating that bill, and I'm not happy about certain aspects of it, but I'm thrilled by other aspects of it. That's the way they go. It's very big. It's the big, beautiful bill, but the beautiful is because of all of the things we have.
But the Tesla CEO isn't the only one of Trump's tech allies that are turning on a plan. For more, let's welcome in here Yahoo Finance's Ben Werschel. Ben.
Hey guys, yeah, so this was a pretty significant break from Musk, and it came after a couple weeks ago when we also broke with the president on tariffs. And his argument for why Elon Musk is opposed to this is the deficit implications. This is a bill that's set to add at least $3 trillion in government red ink in the coming decade if it's passed as is, and Musk described it as undermining the work of Doge. And what I wrote about today was how this is actually there's a similar case being made across the tech world among Trump allies on this. One locus of this is a podcast called the All In podcast, which is kind of the center of the Trump tech alignment. And it's had sort of a run of episodes that have really slammed this bill in pretty harsh terms. One venture capitalist on that, Chamath Palihapitiya, a year ago was co-hosting a fundraiser for Trump, and in the recent days he's had really harsh terms for it, calling it an albatross. David Sachs is another co-host there, and he works for Trump now, and he's defending the bill still, but in kind of measured terms, saying this is the political reality. And as you heard from that quote there from Trump, that's the case Trump is making as well. And it comes in sort of this larger reaction, though, to this bill and the cost implications. You see it from the tech world, from the bond markets to voters as well, really questioning whether this bill is sustainable. And it's at the very least so far has moved Trump from his initial stance after the bill passed, basically saying the Senate should pass it as is and get it to his desk, to offering more changes and offering that he has objections to at least some parts of the bill.
So I guess the question has been, Ben, does it matter? In other words, these people were quite helpful to the president when he was trying to get elected. Now that he's been elected and he's, sort of enacting his agenda, the fact that they are not fans of this bill, can they make it more difficult for the bill to get through?
I think they can to a certain sense. I mean, these are huge donors. Musk has already talked about how he's less likely to give money going forward. Today's events make him seem even less likely to do it, especially if they pass this as is, and we have a midterm coming up with these lawmakers facing it. So they can push it there. I think the way the temperature really changes is that these tech group, are watching the bond markets in generally. So we're seeing signs from there that the bond market doesn't like this bill. If that gets louder from there, I would expect this group to get kind of exponentially louder, because that is what they're most worried about, is that a kind of spiral that could come from this.
Thank you, Ben. Appreciate it.
Okay.
Nvidia set to report earnings after the closing bell today, but first, our very own Brian Sazi takes a look at what to watch from the report as well as the earnings call. Take a look.
This is Yahoo Finance. I'm executive editor Brian Sozzi and host of the Opening Bid podcast. The earnings event of the season is here. After the market closes today, Nvidia will report its first quarter results for fiscal year 2026. Wall Street is expecting the AI chip darling to post strong showings for both earnings and revenue. Analysts forecast that earnings per share, or better known as EPS, will come in at 88 cents, a 46% increase year over year. Revenue is expected to reach $43.3 billion, a 66% jump from the same quarter last year. These are some sizzling numbers, though less sizzling than Nvidia posted in 2024. Nvidia's earnings report is about more than just the company. It's a bellwether for the AI boom, which is showing some signs of a slowdown. For context, this time last year, Nvidia reported record quarterly revenue up 262% year over year, nearly 4 times the year over year growth expected this quarter. And after briefly becoming the world's most valuable company by market cap earlier this month, Nvidia's shares are now slightly down year to date. The pullback reflects investor anxiety about the pace of AI adoption and whether Nvidia can maintain its explosive growth rates. On the Q1 earnings call last year, founder and CEO Jensen Huang said, quote, "The next industrial revolution has begun." Well, now we want to know where it's all headed. This earnings call isn't all about the numbers. It's about the narrative and tone Nvidia sets for the rest of the year. Here are the top 3 things you should be tuning into on Nvidia's earnings call tonight. First, pay close attention to comments about AI demand and data center growth. Nvidia's data center segment, driven by AI chips like the H100 and its Blackwell platform, accounts for the lion's share of its revenue. Analysts will be listening for signals about cloud providers and hyperscalers like Amazon, Microsoft, and Google. Namely, are they still placing large orders? Are there any hints of softening demand or delayed deployments? If so, it could rattle investor confidence in the AI infrastructure build-out and Nvidia stock. Second, pay attention to comments about Nvidia's gross profit margins, which are under pressure. Nvidia has been benefiting from premium pricing on its high-performance chips. But with increasing competition from AMD and custom silicon efforts from big tech, margins may come under more pressure. Investors will want to know if Nvidia is maintaining its pricing power or if it's beginning to feel cost compression, especially as it prepares for the high-volume rollout of Blackwell chips. Third, pay attention to forward guidance. Investors want to know whether demand is still accelerating or beginning to plateau. Any hint of slowing revenue or CapEx from key customers could prompt a reassessment of Nvidia's valuation. On the flip side, a bullish forecast, especially tied to Blackwell adoption or new enterprise use cases, could reignite momentum. Also listen for updates on supply chain capacity, chip launch timelines, and geopolitical risks. Analysts may press CEO Jensen Huang on tighter U.S. export controls, which led to a $5.5 billion loss related to restricted chip sales to China. We'll have full coverage of Nvidia's results after the market close and instant analysis of the earnings call right here on Yahoo Finance. Don't forget, this isn't just Nvidia's moment, it's a checkpoint for the AI trade. I'm Brian Sozzi. For more, check out the Opening Bid podcast. Thanks for watching.